Welcome back to the Deep Dive. We have covered a lot of business books on this show, some trendy, some biographical, some that promise to make you rich by next Tuesday.
Right.
But today feels different. We aren't just looking at a bestseller. We are looking at the source code.
That is probably the best way to describe it. We're talking about the 6th edition of Security Analysis by Benjamin Graham and David Dodd.
The Bible of value investing.
It really is. First published in 1934, updated in 1940. And just to be clear for everyone listening, this isn't a history lesson for the sake of history. This is the book that taught Warren Buffett how to invest. It practically invented the profession of financial analysis as we know it.
But here's the challenge, and I want to address this right up front because I know what some of you are thinking. The original text was written in the middle of the Great Depression. The examples are railroad bonds and textile mills. So the mission for this deep dive is to figure out how a system built for a collapsed economy in the 1930s is still the bedrock of modern finance. How does this heavy 700-page academic text create billionaires in the age of high-frequency trading and AI?
To answer that, you have to start with the context. You really have to transport yourself back to 1934. James Grant writes the introduction to this edition, and he paints a very specific, very grim picture.
Right.
The 1929 crash had destroyed fortunes. The Depression was just grinding on. The prevailing mood wasn't just markets are down. It was, as Grant puts it, that financial debacle was to be the permanent order.
Wow. That is such a heavy phrase. Financial debacle was to be the permanent order. Like the sky has fallen and it's staying down.
It captures the despair perfectly. And because of that despair, investing as we know it, it didn't really exist. Before Graham and Dodd, the market was seen as a casino.
Just gambling.
It was either gambling or an insider's game.
There were no rules, no SEC.
Very few rules and almost no transparency. Disclosures were terrible. Grant mentions a great detail that really drives this home, even Dun and Bradstreet.
The information company.
The information company. Their entire business was selling financial information about other companies, and they refused to reveal their own earnings to their own shareholders.
That's the definition of irony, right?
Exactly. So in this environment, stocks were considered inherently speculative. If you wanted safety, the conventional wisdom was that you bought bonds. If you bought stocks, you were gambling.
And Graham and Dodd stepped into this chaos with a radical idea.
A completely radical idea. They wanted to replace that emotional gambling with a rigorous, logical discipline.
They wanted to bring the scientific method to Wall Street. And that starts with their definition of what an investor actually is.
Yeah.
I feel like in most fields, definitions are boring semantics. But here, the definition seems to be the whole ballgame.
It is the foundation. They draw a hard line in the sand between investing and speculating. And it wasn't about whether you bought a stock or a bond. It was about how you bought it.
So what is the text's official definition? Because I know people quote this all the time.
They wrote, an investment operation is one which, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative.
Okay, let's unpack that. Thorough analysis and safety of principle. It shifts the focus entirely from how much money can I make if this rockets to the moon
to how do I make sure I don't lose what I have?
Exactly. It just turns the conventional wisdom upside down.
Completely. In the 1920s, people thought safety came from the form of the security, like a bond is safe because it's a bond. Graham said no. Safety comes from the relationship between the price you pay and the value you get.
So you could speculate in a bond.
You can absolutely speculate in bonds if you pay too much, and you can invest in stocks if you pay the right price.
Which brings us to the core concept of the book, intrinsic value. This is a term people throw around constantly on, financial news. But what did Graham and Dodd actually mean by it in 1934?
They defined intrinsic value as the value that is justified by the facts, assets, earnings, dividends, future prospects, as opposed to the market quotation, which is just driven by psychology.
But is that a specific number? If I'm analyzing a company, is the intrinsic value exactly $42.50?
Yeah.
Because that sounds like a lot of pressure to get right.
No, and that is a common trap people fall into. They think thorough analysis means calculating a precise figure to the second decimal. Graham and Dodd were very clear. You don't need a precise number.
They have a great analogy for this in Chapter 1, the woman's age analogy.
It's a classic. They argue that you can look at a woman and be quite sure she is old enough to vote without knowing her exact age. You don't need to know if she's 32 or 34 to know she's over 21.
Or you can look at a man and know he's overweight without knowing his exact weight to the pound.
Right. So as an investor, you don't need to know a stock is worth exactly $80. You just need to know, with high confidence, that it's worth substantially more than the $40 it's selling for.
You're looking for the obvious mismatch. You don't need a scale to know a whale is heavier than a dog.
Exactly. If the gap is wide enough, the precise figure doesn't matter. And that gap, that is what they call the margin of safety.
This is the concept that Warren Buffett always talks about, the secret sauce.
It is the central unifying concept of value investing. Seth Klarman, the billionaire founder of Baupost Group, who wrote the preface to this edition, calls it the buffer.
The room for error.
It's the room for error because you might be wrong. The economy might tank. Management might mess up.
Klarman has a simple way of putting it. It's about buying a dollar for 50 cents.
That's the goal. And this ties back to the psychology of the value investor. They are defined by risk aversion. Klarman uses a coin flip analogy to test this mindset. If I offered you a coin flip where it heads you double your net worth and tails you lose it all, would you take it?
Absolutely not. I like my house too much.
Most rational people wouldn't. The pain of losing everything far outweighs the pleasure of doubling your money. But in the stock market, people take bets with that kind of risk profile all the time without realizing it.
They don't see it as a coin flip.
They don't. They buy things purely on the hope they'll go up without any floor beneath them. Graham and Dodd teach you to demand that margin of safety so you aren't flipping a coin with your financial life.
Right. And Buffett, in his foreword, calls this book a roadmap he's followed for 57 years. But he makes a really interesting observation about this whole mindset.
The inoculation.
Yeah, the inoculation, like a vaccine.
Yes. He refers to his famous article, The Super Investors of Graham and Doddsville. His point is that you either get this concept immediately, the idea of buying a dollar for 50 cents, or you never get it.
Really? Never.
He thinks so. You can talk to someone for years, show them the data, show them the track records, but if they have a speculator's mindset, if they're chasing action, it just won't stick.
It's almost a personality trait. You either have the patience to wait for the 50-cent dollar, or you don't.
And if you do have it, you need the technical tools to find it. Because security analysis isn't just philosophy, it's a manual. And interestingly, a huge chunk of this book is actually about bonds.
That surprised me when I looked at the table of contents.
Yeah.
We usually think of Buffett and value investing as stock picking. But Graham starts with debt.
He does.
And we have Howard Marks, another legendary investor, introducing the bond section in this edition. He calls bond investing a negative art. What on earth does he mean by that?
It means it is a game of exclusion. Think about stocks. You're hunting for the big winners, the next Amazon or Apple. The upside is theoretically unlimited.
Right.
But in bonds, the best case scenario is that you get your interest payments and your principal back. That's it.
The upside is capped. You can't get extra interest just because the company does well.
Exactly. You can't win big in bonds. You can only lose. So you don't win by finding winners. You win by avoiding losers. You win by ensuring the borrower doesn't default.
So the mindset is pure defense.
Pure defense. And because of that asymmetry small upside, total downside, Graham and Dodd established a rule that Howard Marks highlights. Bonds should be bought on a depression basis.
A depression basis. I assume that means you don't analyze the company based on how it's doing today.
Okay. You don't ask if a company can pay its interest when the economy is booming. I mean, a ham sandwich could pay interest in a boom. You ask, can this company pay me back if the economy collapses? If earnings drop 50%?
Wow.
If the answer is no, it's not a safe investment.
You are stress testing everything against the worst case scenario. Now, moving from bonds to stocks, there was a famous strategy Graham used called the net-net.
Oh, yeah.
Bruce Greenwald discusses this in his intro to the balance sheet section. This seems to be the ultimate cigar butt investing.
It is. In the 1930s, things were so cheap that Graham could find companies selling for less than their net current assets.
Okay, we need to break down the math on net current assets, because it sounds technical, but the logic is actually very simple and kind of beautiful.
It is simple. Take a company's current assets, so the cash in the bank, the inventory on the shelves, and the receivables. Now, subtract all the liabilities, all the debt, everything they owe.
So this is the liquidation value. If the company closed its doors today, paid off everyone, this is the cash left over.
Right. And Graham was finding companies where the stock price was lower than that number. It's like buying a house. Finding a safe in the basement with more cash in it than you paid for the house, and getting the house itself for free.
That sounds impossible in today's market. Who would sell a dollar for 80 cents?
It is very rare today. Information travels too fast, people spot those bargains instantly. Greenwald notes that. But the principle remains. Asset values provide a floor.
Oh,
Even if you aren't buying net nets, you should be looking for companies where the tangible reality of what they own protects you if the earnings disappear.
But this leads to the biggest critique of the book, doesn't it? I mean,
Yeah.
the world has changed. The examples in the book are railroads and heavy industry. Today, the biggest companies are asset light. Google and Microsoft don't have giant factories filled with inventory. Their value is in code and intellectual property. Does Graham's method still work?
That is the big question. Bruce Greenwald addresses this directly. He argues that you can and should value modern companies using these principles, but you have to adapt what you count as an asset.
How so?
For a company like Intel or Google, the asset isn't a physical factory, it's their dominance, it's their moat. If it would cost a competitor $100 billion to replicate Google's search dominance, that is a form of asset value.
It's an earnings power value.
Exactly. So the stability of their market position becomes the proxy for the tangible assets Graham looked for, but the discipline is the same. You still demand that the price you pay is lower than that calculated value.
You don't just buy because tech is the future.
Right. And there's another modern shift mentioned by Glenn Greenberg in his section, the focus on cash flow versus earnings.
This is crucial, right?
It is. Back in 1934, companies didn't even have to publish cash flow statements. They just reported net income. But today, we know that net income is, well, it's an accounting fiction. It can be manipulated.
Accountants can make earnings look like whatever they want, within reason.
Exactly. But cash is reality. You can't fake the cash balance in the bank. Greenberg argues that a modern Graham and Dodd investor focuses relentlessly on free cash flow, the actual cash the business generates.
So the tools evolve, from balance sheets to cash flow statements, from factories to moats, but the philosophy of buying something for less than it's worth stays the same.
And the geography evolves too. Thomas Russo writes about globetrotting with Graham and Dodd. He points out that while the U.S. market is very efficient and hard to beat,
Yeah, it's tough.
the principles apply everywhere.
So if you can't find a 50-cent dollar in New York, look in Tokyo.
Or a family-owned brewery in Europe, or a manufacturing firm in emerging markets. There are places in the world today that look a lot like the U.S. in 1934, ignored, unloved, and incredibly cheap.
The geography changes, but the math stays the same.
Exactly.
Speaking of unloved things, we have to mention J. Ezra Merkin's section on distressed investing. He's a quote that I think is one of the best lines in the whole book. Capitalism without bankruptcy is like Christianity without hell.
It's a powerful image. It means that failure is a necessary part of the system. And for a value investor, a company in bankruptcy or distress is the modern playground for that depression basis analysis.
Because that's when everyone else is selling.
Right. When everyone else is running for the exits because a company is in trouble, that is often where the deep value lies if you have the stomach for it.
They have the stomach for it. That really seems to be the crux of it. We've talked about math and assets, but so much of this book is actually about psychology.
Oh, completely.
Graham seems to have been doing behavioral finance decades before it was a recognized field.
He really was. He understood that the market is bipolar. That's why he created the character Mr. Market.
This is probably the most famous metaphor in investing history.
It is. Graham asks you to imagine that you own a business with a partner named Mr. Market. Every day, he knocks on your door and offers to buy your share or sell you his, but the guy is emotionally unstable.
He's manic depressive.
Totally. Some days he's euphoric, sees only sunshine, and names a wildly high price. Other days he is terrified, sees only doom, and offers to sell to you for pennies.
And Graham's point was, you don't have to listen to him.
You don't have to let his mood dictate your view of the value. You use him. When he's depressed, you buy. When he's euphoric, you sell. But you never, ever let him tell you what the business is actually worth.
You figured that out yourself in a quiet room with the financial statements.
Yes. And this brings up a massive conflict with the academic world, doesn't it? The efficient market hypothesis.
Oh, it's a huge conflict. Starting in the 60s and 70s, academics argued that the market is efficient, that the price always reflects all available information.
Right, and therefore Mr. Market isn't crazy. He's right, and you can't beat him.
But Graham and Buffett and Klarman, they clearly beat the market for decades.
Consistently. David Abrams, in his intro, discusses this conflict. He calls the idea that you can't find bargains the great illusion. Graham says the market is a voting machine in the short run.
driven by popularity and emotion.
And a weighing machine, only in the long run. The opportunity exists because people are emotional. Abrams makes a vital distinction between market analysis and security analysis.
Okay.
Market analysis is trying to predict if the market will go up or down. Graham says that has no margin of safety. You're either right or wrong. It's guessing.
It's just guessing.
But security analysis, that is valuing a specific business. That is where you find safety. You don't have to predict the next election to know that a company selling for half its cash value is a good buy.
It is empowering, really. It says you can ignore the macro noise.
That's it.
As we wrap up, I want to touch on the human side of this. We talk about Graham and Dodd as these titans of intellect, but reading the tributes, especially from Buffett, you get a sense of their character.
Yeah.
And it seems to contradict the Wall Street shark stereotype.
That is a really touching part of the book. Buffett says that Graham and Dodd were brilliant, yes. But more importantly, they were generous.
Generous half.
Graham didn't hoard his secrets. He wrote this book to give them away. He taught classes at Columbia where Buffett was his student, and he shared everything. He was literally teaching his own future competitors how to beat him.
Buffett writes, "It was ordained at birth that they would be brilliant. They elected to be generous and kind." That's a choice.
It is, and I think it reflects the discipline of value investing itself. It requires a certain humility. You have to admit you don't know the future. You have to admit you might be wrong, hence the margin of safety.
Right.
It's an intellectually honest way to view the world, and that honesty seemed to bleed into how they treated people.
So what is the final takeaway here? If a listener picks up this 700-page brick of a book, what is the core lesson they should walk away with?
It's not a formula. You aren't going to find a magic ratio that works in every market. It's a mindset. It's about skepticism. It's about discipline. It's about insisting on value and refusing to speculate no matter how much money your neighbors are making on the latest fad.
It's about being willing to look stupid in the short term to be right in the long term.
That's it perfectly.
And here's a thought to leave you with. We live in a world of instant information. Bloomberg terminals, 24-hour financial news, Twitter.
You would think markets would be more efficient now than in 1934 because everyone has the data.
But ask yourself this, does all that noise make people more rational, or does it just amplify the emotion?
Does it make Mr. Market more manic and more depressive?
I would argue that it does. The sheer speed of information might actually be making the market less efficient and more emotional.
Which means the opportunities for the disciplined, patient investor might be better today than ever before. Something to mull over.
Indeed.
That's it for this deep dive into security analysis. Thanks for listening.